Hi, welcome to this podcast where I'm going to be looking at absorption costing and marginal costing and their use in the final accounts. Okay, just a little bit of theory on this. For my students, you are A2 students, you did absorption costing at AS. So hopefully you will have gone over this briefly before you started to read the video. Okay, it's focused very much on manufacturing business. And the only area of the accounts it really makes any difference on is cost of sales or cost of goods sold. Okay, cost of goods sold, you've obviously for a manufacturing business, you've still got the opening inventory. You then have the manufacturing costs, and that will include two types of costs. It will include the fixed manufacturing costs and the variable manufacturing costs. And then the final thing is the closing inventory. An important thing to remember in all this is some of this will not change at all. Okay, so if you look here at the manufacturing costs for both marginal costing and absorption costing, that will include all the fixed and variable costs for the year. Where there is a difference is for marginal costing, when we're valuing the inventory, it will only include the variable cost per unit for that year in the inventory valuation. And when we look at absorption costing, it won't just include the variable cost per unit, but it will also include a pro rata share per unit of the fixed costs when we calculate the inventory. Okay, so the only difference is in the inventory. And I was going to say always, but that's a dangerous thing to say, but nearly always you will find that the opening inventory will be given to you in an exam question and you will just be calculating the closing inventory. Okay, so what does all this mean? Okay, what this means is most of the information is pretty straightforward. Okay, we're going to be doing a income statement for both marginal costing and for absorption costing. Okay, we've got the revenue figure. That won't change no matter which type of costing we're using. In this question, I've given you the opening inventory. The opening inventory won't change in the cost of sales calculation. Okay, the manufacturing cost is going to be the same under both scenarios. So for the manufacturing cost, it's going to be the 15,000 of labour costs, the 10,000 of material costs, and the 40,000 of fixed costs, coming to a total cost of 65,000. And that's going to be the same in both extracts from both income statements. The bit that's going to be different is when we calculate the inventory unit cost at the end of the year, and then the total inventory cost. When we're doing marginal costing, we're just going to use the 15,000 and the 10,000. And what we're going to do is we're going to divide 25,000 by the amount of output, which in this case is 10,000. And that gives me a unit cost of $2.50. And then I'm going to multiply that by 5,000. I've made a mistake here. Well, that should have an extra zero, and it's 5,000 units. Okay, and that gives me a total cost for my closing inventory of $12,500 under marginal costing. And then I just do the normal cost of sales calculation, opening inventory plus manufacturing cost, subtract the closing inventory, gives me my cost of goods sold of 72,500, and that gives me a gross profit of 27,500. Okay, when we do the same thing for absorption costing, we also add the 40,000. So we do 25,000 of variable costs plus 40,000 for fixed cost gives me 65,000 divided by 10,000 units, and that tells me that I'm going to it's going to cost me $6.50 per unit, and that's the real cost of manufacturing. Okay, and then I'm going to calculate the total inventory costs, where I would do 5,000 units because I've got 5,000 units in inventory times 650 equals 32,500. That gives me a cost of sales of 52,500, and my gross profit is going to be higher. And it's going to be higher because my cost of sales is going to be lower. And it's lower because the closing inventory is a minus figure, and it's a bigger figure because it includes an element of the fixed costs in there. If you remember back to those of you I taught IGCSE and AS accounting, closing inventory is a credit entry, and therefore increasing closing inventory is going to increase my profit. Now, obviously, the important thing here is that changing our method of inventory valuation, as if you remember back to when we did FIFO and LIFO for those I've taught, has an impact on both the costs of goods sold and therefore on the gross profit. And there are a couple of rules in here. So if we just go and look at this theory page now, okay, if inventory increases, marginal cost will give a lower profit figure. And that's because marginal costing gives you a higher cost of sales if we increase the inventory, and therefore a lower profit. However, if inventory decreases, absorption costing will give the lower profit figure. And if the opening and closing inventories are exactly the same, well, to be honest, it doesn't matter which you choose. Okay, it will have no impact because the manufacturing cost will be the plus the opening inventory minus the closing inventory will just give you the manufacturing cost as being the cost of goods sold. Okay, so that's quite an important thing. Okay, I'm going to do the theory again, comparing absorption costing and marginal costing. On the exam board that I cover, they do sometimes ask a specific question about comment on the use of absorption costing and marginal costing for inventory valuation. I don't particularly like their answers because they tend to spill over, if you like, into the general discussion about which is best, marginal costing and absorption costing. And in reality, both are good for the right thing. Okay, so I'm going to give you sort of a model answer. I'm going to explain why some bits of it I don't really like very quickly. Okay, the most important thing in favour of absorption costing is International Accounting Standard 2, which covers inventory, says it should include all the costs of conversion, and that includes fixed costs. So actually, IAS 2 ultimately also says we shouldn't use marginal costing because it doesn't consider the fixed costs when valuing the inventory. And therefore, this conversation is a little bit irrelevant because in the final accounts, we can't use absorption costing for marginal costing for the valuation of inventory. We can only include full costing, and a method of full costing is absorption costing. Okay. Absorption costing clearly follows a matching concept. So we're matching the cost of the goods that we sell with the period in which we sell them. The goods that we don't sell, we move them by subtracting them in the cost of sales calculation to the next year, and those costs will be reflected in next year's expenses. And then this is where we're getting over really away from the question of absorption costing and income statements and closing inventory valuations, and more into a general reason for using absorption costing, but the mark schemes allow it in Excel. And in terms of decision making, okay, because absorption costing includes all the costs, then hopefully the prices that a business charges should be sufficient to ensure a profit is made. Okay, so they're the advantages with using absorption costing. The advantages with using marginal costing, the first one that's commonly used is the fact that it follows prudence, because in general it gives a lower value on the closing inventory. I don't particularly like that answer because provided we're going to sell the goods for more than we're valuing them at the inventory, then really there's no particular reason for following prudence. And also, as we've already discussed, there are scenarios in which absorption costing will give a lower profit. And again, it gives a lower value for the closing inventory, which prudence says we should look at the lowest realistic value for the closing inventory. But again, we've also got matching in there, provided we intend to sell the goods for more than the value we've put on the closing inventory. It's a little bit tenuous as to whether we should be doing that. Not all the costs of a time period will be allocated to the time period. That's really just straightforward conflicting with matching. It's saying that costs are incurred in a particular year, and therefore there is an argument that we should be including all the costs in that year as part of the expenses of that year. And again, this is really a slightly tenuous argument, okay, because it's going back to the fact that, as I will discuss in another video, marginal costing is a fantastic tool for making short-term decisions a business needs to make on an ongoing basis. And therefore, most businesses use both absorption costing and marginal costing for the right job. And what may happen if you ignore marginal costing altogether, then you will miss out on some short-term opportunities which will make a positive contribution to a business. And just a very quick comment as well, it's not really absorption costing that we are doing here, because absorption costing generally is done at the start of the year, but we're sort of applying absorption costing again at the end of the year in those basic tools. But absorption costing is normally a budgeting thing done at the start of the year. Right, for my students, obviously email if we've got any questions. We'll discuss the theory when we have a face-to-face meeting, and I've done you a question to have a go at. Okay, thank you very much, best wishes, and obviously let me know if you've got any problems.